This Week in Economics on the 24th of December, 2017, the day before St. Nicholas flies down the chimney, according to a popular adage, in North America, a children's situation. I was reading earlier, maybe last week, a Christmas story from Mr. Grisham, the Mississippi lawyer turned writer, John Grisham. Interesting little story there of a gentleman that was going on a holiday in the Caribbean, and he abandoned the Christmas lights ceremony, the tree, etc. But due to things beyond his control, he ended up staying in his neighborhood for the holiday. Nonetheless, from WBRN Radio in Boston and on the Bostonred Network, we look at the field of macroeconomics here. We'll start with the National Income and Product Accounts. This is from the Department of Commerce Bureau of Economic Analysis. Big data comes to see us. Nonetheless, real gross domestic product, that's GDP, increased at an annual rate of 3.2% in Q3. That's according to the third estimate, which is the most complete estimate to date. In the second quarter, real GDP was 3.1%. The estimate today is, of course, they put a caveat here on more complete data. In the second estimate, the increase in real GDP was 3.3%, with the third estimate for the third quarter personal consumption expenditures increased less than previously estimated, but the general picture of economic growth remains the same there. So we usually have between the second and third a little variation. This is 0.1%. Real gross domestic income, that's GDI, increased 2.8% in Q3, compared with an increase of 2.3% in Q2. The average real GDP and GDI, a supplemental measurement of U.S. economic activity, that equally weighs GDP and GDI, increased to 2.6% in Q3. Anyway, compared with an increase of 2.7 in Q2. We'll attach this, incidentally, to the program description. The increase in real GDP in the third quarter reflects positive contributions from personal consumption expenditure, that's PCE, private inventory, non-residential fixed investment, exports, federal government spending, state and local government spending, but were partially offset by negative contributions from a residential fixed investment, imports, which are a subtraction from the calculation of GDP, decreased. The slight acceleration in real GDP in the third quarter primarily reflects acceleration in private inventory investment and upturn in state and local government spending that were partially offset by deceleration in PCE, non-residential fixed investment, and exports. Current dollar GDP increased at 5.3%, or $250.6 billion in Q3, a level of $19,350.6 billion in the second quarter. Current dollar GDP increased to 4.1%, or $192.3 billion. The price index of gross domestic purchases increased to 1.7% in Q3, compared with 0.9% in Q2. The PCE price index increased at 1.5%, compared with 0.3% in Q2. Excluding food and energy prices, the PCE price index increased 1.3%, compared with 0.9% in Q2. Updates to GDP. The downward revision to the percentage change in real GDP reflects a downward revision to PCE that was partially offset by upward revision to state and local spending. Now we actually get to this, the estimate. This is the advanced, the second, and of course the third estimate of real GDP went from 3% in the advanced estimate to 3.3 in the second, and finally the third estimate at 3.2. Current dollar GDP at 5.2% in the advanced estimate, and the second estimate at 5.5%, and then 5.3. Real GDI at 2.5% in the second, and 2% in the third, is which one we're dealing with here. The average real GDP and real GDI at 2.9% in the second estimate, actually revised downward. That's the trend here, is revised downward to 2.6%. Gross domestic purchases, price index at a 1.8 in the second estimate, actually was at 1.7 in the third. More realistic view, the PCE price index remained at 1.5%. Corporate profits. The current production of corporate profits with inventory valuation adjustment and a capital consumption adjustment increased 90.2 billion in Q3, compared with an increase of 14.4 billion in Q2. Profits of domestic financial corporations increased at 47.8 billion in the third quarter, in contrast to a decrease of 33.8 billion in the second quarter. Profits of domestic non-financial corporations increased 10.4 billion, compared with an increase of 59.1 billion, and that would be in Q2. The rest of the world profit increased at 32 billion, in contrast to a decrease of 10.8 billion in Q2. In the third quarter, receipts increased 26.9 billion, and payments decreased at 5.2 billion. So this is basically laying it all out here. The next report will be on, let's see here, the advanced April 27th of 2018, and May 30th. The second and the third will be on June 28th. So that is the schedule, and that does it for that part of it. Let's now go to, we've had some anecdotal information out here, and the tax cut. Now, this is a political interpretation. This is not an economic interpretation, but this is by Larry Crenslaw. He is a right-wing columnist, but basically what he's laying out here is the supply side case for the tax cuts. And what is happening here, he says, one of the more incredible things about the story is almost the immediate support of large corporations. Why not? Bank of America announced a $1,000 bonus tied to the tax cut, affecting 145,000 workers. AT&T and Comcast announced also the $1,000 bonus for more than 300,000 people combined, along with a substantial new investment in the U.S. Ditto for Boeing. Well, the situation there is, it's not unusual for corporations to give end-of-the-year bonuses, particularly the banks, because the banks have been very profitable of the last year, 2017. That not said, it's not unusual for the banks to cooperate when they receive tax gifts. So we'll leave it at that. And more banks have joined the parade. Wells Fargo, third, raising their minimum to $15 an hour. Now that's for clerks and various other people. We'll go and look at those from 2016 and see exactly where they were, and I think you'll understand what's going on here. And to the massive corporate tax cut. Now that tax cut finally arrived. It's from 35% to 21%. It was going to be 20%, and then we heard 22% there. So it's a little situation there, a little different. At the old 35% rate, our company's took home 65 cents on the extra dollar, and at the new rate, they'll take home 79 cents according to this. This is less than a 10 cents increase. But they are at now at 21. Now, remember, the corporations, none paid 35%. They roughly paid about 22% at the most. The result in the business boom, where new capital formations and productivity increase the economic potential to grow. Well, we'll see on that. Counter-inflationary, we can say goodbye to 1 and 2% secular stagnation, hello to 3 to 4% long-term prosperity. That situation in itself, from what we just read to you, does not necessarily bear out. Now, yes, we are at 3%, 3.1, 3.2 growth, but is it sustainable? We'll see. And he goes on here to talk about various other things here that roughly could or could not happen. We'll remember these are commentaries. The Tax Foundation, that is a writer-center operation. Single earner at $52,000 claims a 36 reduction in tax liability. A married couple, now this is kind of interesting here, at $85,000 would get a 20% reduction. But again, that's a married couple. And married or filing jointly, earning $2 million would get a 3% reduction in tax liability. Well, that doesn't bear out. Let's see if anything else he has here. He does reference the tax cuts by John F. Kennedy and Ronald Reagan, and of course Jack Kemp proposed that the Laffer curve. The rest of the supply side clan, now including he includes DJ Trump, but supply side has never worked out. In fact, the management and budget person in Reagan's administration just called it voodoo economics, which is better 1 or 2% stagnation or 3 or 4% prosperity. Well, a lot of that would depend. Economies never remain stagnant. And what we're looking at in 2017 is the result of the economic policies of the administration of Barack Obama. Sorry about all the infinitives there. Whereas in 2018, we'll start looking at more of the DJ Trump effect here because of tax cuts. But it'll take a while for these tax cuts to actually show up. Yes, people will have more disposable income, but where the disposable income goes, and a lot of that will also depend on petrol pricing, which we'll get to later here. And let's look at these hourly benefits from these banks. We go to, let's see, we are going to make sure we get this. We're going to use several things here. Pay scale, we've used those before. We're going to use them here. This is by Ms. Smith from Bloomberg, where we're getting this. Hourly bank workers' pay is still up short. That's according to advocates here. Labor and employment from Bloomberg, Laura Rhonda Smith, writing on the 21st, I believe, of 25th, 2016. Anyway, we look at some of the lowest paid workers in the U.S. These are the banks. J.P. Morgan Chase, decision to raise its minimum hourly between $12 and $16.50 over 3 years. So, in other words, when they talk about $15 an hour, they were already planning to do this. And isn't enough, according to employment advocates. The banking industry, however, says their starting hourly is above the federal minimum. Yeah, $7.25, no doubt about it. So let's look at where these people are. Tellers make an average of $12.77 an hour. Customer service representatives $16.16 an hour. Loan interviewers and clerks $17.85 an hour. New account clerks, what do they make? $16.72. They're above the 15 rate. And bookkeeping, accounting, and auditing clerks make $17.54. Now, that was in 2015. The source of that is from the Bureau of Labor Statistics, May of 2015. Wait a minute. Yeah, 15. Anyway, nonetheless, and finally, billing and account collectors, they make $17.48. Minimum hourly wage rates from some of the largest companies: Wells Fargo, Bank of America, Citibank, Capital One, Bank of New York, Mellon, State Street Bank, some have been mentioned by Critchlow here, are in the same ballpark as J.P. Morgan, as according to price scale. And let's see what else is going on here. But in industry, the American Bankers Association ranks the largest 50 institutions by consolidated banking assets, and they're using the data from the Federal Deposit Insurance Corporation. The stands to hold $16 trillion in assets, is the American Bankers Association. Pay rates have had hover around $15 an hour, should be much higher, no doubt about that. $15 an hour for workers at the bottom should be the bare minimum asked of the banking industry. That is Paul San, the National Employment Law Project. Anyway, moving on here, $50 per hour at First Republic, Sun said, but banks like First Republic, which raised a pay to $20 an hour, saw profits increase. They're showing that the industry can do it. Now, this is $5 above Larry Critchlow's situation. First Republic is in California, and they have employment benefits. The bank pays a minimum hourly of $20 to full-time, part-time, and temporary workers, including interns. So I suppose if you want to go work for somebody, go work for First Republic. The fight for 15, we've talked about it before. Fast food workers in places like New York. Tellers' wages start around $10.87 an hour. 446,620 bank tellers in the U.S. earn a medium hourly of about $12.77. That's 2015. This is out of pay scale based in Seattle, Washington. The database, of 15 million. This is big data going here. Individual salary profiles, says on this website. An average of a bank teller can expect to earn about $10.87. Almost 75% of bank tellers earn less than $15 an hour. No doubt about it. And they're also being replaced by automated tellers. I don't know if they put this in here or not. They aren't keeping up with the pace in this decline of higher wages. And incidentally, pay scale says that some bonuses approaching $1,000 and certain profit-sharing proceeds reaching $3,000. Total annual income of bank tellers can range, that's with the $1,000 bonus, from $18,000 to $30,000 depending on individual performance. Wage ranks at Wells and Citibank. They range anywhere from $12 to $16.50 depending on the location of the bank. Citibank workers enjoy the largest paychecks, according to $18,000 a year is the medium salary there, but it would depend obviously on where they live. Citibank tellers there can earn an average of $15 per hour in the U.S. That's according to a spokesman there. And Bank of America SunTrust also offers top salaries for bank tellers according to pay scale. Workers at those banks can expect to earn $25,000 a year. And under the new tax plan, they'll get about $65. Banks with the smallest paychecks there, PNC Financial Group is one of the smallest out there. 18 to 26 other banks having a reputation for low average pay. Third Bankrust, Federal Credit Union, and U.S. Bank. So some of the smaller ones there. In October, bank workers from across the U.S. met in Los Angeles to protest what they described as declining work conditions at banks, including the J.P. Morgan Chase Bank of New York Mellon, the 8th largest bank in the U.S. Coalition members demanded increase a fair share of profits for bank workers. So this is some of the things that has happened here that put this on. While we're here, and this is the holidays, gender pay gap, and this is, let me see, when did they put this out? I don't know, but anyway, recently here, this is at pay scale. Gender pay gap, the story you think you know, that women earn 76% of the dollar compared to men, doesn't paint a complete picture. Pay scale reports in its gap analysis. Facebook a live broadcast, this is on April the 4th, so I think it's a little bit dated, but anyway, it was on that website. Put it up there. In 2016, women were earning less than men. This year, still present in both uncontrolled and controlled groups. The 74 cents there, women earn 23.7% less than men. Men are 85% more likely than women to be vice presidents or C executives by mid-career. 171% more likely to hold those positions later in their career. And some of the stuff that they have up here, perceived employment action, impact on employees' engagement. 17% of men believe there's an issue and their employer is proactively addressing it, while 10% of women feel the same. Again, the education levels play a role in the perception. Generally, the more educated women, the more likely she is to give her employer a low rating on addressing workplace gender inequality, with female MBAs and female PhDs reporting higher levels of dissatisfaction. 34% of female MBAs report a little or no action is being taken by the employer, and 37% of the PhDs the same. So in other words, education is not affecting these women. The new pay scale research indicates employees, or workers we'll call them, are more likely to be to identify gender inequality issues at their workplace than their managers or leaders of the company. Roughly 57% of employers say there is no gender inequality issue at their business, and that the need that needs to be addressed, whereas only 47% of employees feel the same. Perception gap in corporate charm. The next 6 months, I plan to actively seek a new job outside of my current job. Both gender workers are likely to leave their job if their current employer does a little to address gender inequality. There's a lot of mobility out there. Education influence perception of gender gap. I think we already talked about that, so we'll kind of move on there. But the educated women are more likely to rate employers lower on addressing gender inequality. For those with no degree at all, 18%, 0.1%, high school 16.1%, associate degrees 15.3%. These are females there. And wait a minute, just a minute, let me get this right here. Yeah, that's right. With bachelor's degrees, 13.8%. The MBAs, 13.8%. And as we move along here, PhDs at 31.1%. Let me get these right here. And MDs at 30.1% there. And this is the basic differences here. More educated women at the master's level, 17.2%. The bachelor's level, 15.4%. MBAs, 25.2%. PhDs, 22.7%. JDs, that's attorneys, at 7.6%. and high schoolers at 8.2%. So associates at 10%. In other words, the higher the education levels, the more the women are there. And if you look at, various ones here, we won't go into all that, but some very good information over at a pay scale. Let's run on to our normal lineup here. And we'll get here in a second. Okay. New home sales in race to more than a 10-year high in November. The Department of Commerce, again, this is on Friday. This is from Reuters, incidentally. Make sure we get to the 22nd. Okay. Anyway, said new home sales jumped 17.5%. Seasonally adjusted annual rate of 733,000 units last month. This was the highest level since July of 2007, right before the Depression hit. Following the October downturn, revised sale pace of 624,000 units. New home sales surged at 26.6% from a year ago, together with last month's surge single-family home building and sales. Previously owned homes suggest the housing market is regaining momentum after stalling this year. Housing has been constrained by shortage of homes for sale, skilled labor, suitable land actually to build the homes on. Economists polled by Reuters had forecast new home sales falling 7.5% to a pace of 654,000 units last month. New home sales, which are drawn from permits, etc., they rose in 4 regions. In November, the inventory of new homes on the market was unchanged at 283,000. November's sales pace, it would take 4.6 months to clear out the houses. The supply of homes on the market, fewer since July of 2016, down 5.4%. So this is basically where the home sales were in November. And here we go again. Wall Street slips heading into the holidays. That's not unusual. Usually they'll have a Santa Claus rally, but I guess not this year. Wall Street's major indexes dropped on a Friday in low trading volume before the holiday weekend. Several blue chips, including Nike, they are in the shoe business, fell 2.3%. United Healthcare Group was down 0.8%. And who else took the bite? Investors are winding down ahead. Of course, the holiday will be on Monday. They'll be closed. Wall Street indexes are on track to end the week higher, buoyed by a historic overhaul of the tax code. It had been a strong week. Said the cheap investment strategy at Jenny Montgomery Scott in Philadelphia, whether the market is a bit is a little bit or down a little bit, is not indicated of long trends. It's easy to push things around when not many people are trading. Yeah, well, people have all really went away. The Dow fell 28.3, 0.11. Anyway, won't get into that now. But some of the companies here for the week, Dow rose 0.42 there. And the Bitcoin market has been plunging around. It plunged below the $12,000 level, losing about a third of its market value in 5 days. It's sort of up and down. It was at 14,000, down she went. Data on a Saturday showed U.S. consumer spending went up in November, and shipments of key capital orders increased for the 10th straight month. The benchmark S&P has climbed about 20% this year and is on track for the best performance since 2013 on solid corporate earnings. And what else do we have? Advanced issues outnumber declining ones. Anyway, volume was 4.81 billion shares on the exchange. On we go. Silicon Valley, much feared tax bill divides workers in Silicon Valley. The tax overhauls a boom to Silicon Valley tech companies like Apple, Alphabet, that is Google, which will enjoy big tax cuts and a chance to bring back billions of dollars from overseas at a reduced rate, contrary to dire warning of California officials, etc. We read this earlier. When did this come out? On the 21st. That's why we read it earlier. Makes sense. The new $10,000 cap on state and local deductions will have a less drastic effect than feared because such deductions in many cases have already been rendered moot by the alternative minimum tax, ATM, a mechanism for assuring that well-heeled pay at least 28% taxes. There's a lot of noise about workers in California, New Jersey, Illinois facing higher taxes, but 80% of our clients are already paying the alternative minimum. Well, the idea was at one time to do away with the alternative minimum. The new law alters the alternative minimum in a way that vastly reduces the number of people who have to pay it from 5 million to an estimated 200,000 next year, according to the Tax Policy Center, combined with a reduction in overall tax rates, a doubling of the standard deduction. Standard deduction, incidentally, was at 12,000. Now it is going to 24. That's for couples. Estimates by 3 experts, I don't know, they don't name them, using roughly the same assumptions, show that a home-owning couple earning a combined $250,000 in Silicon Valley will likely see an increase or decrease in their tax bill of a few $100s. A married couple with no children who rent a house make a contribution, a combined $150,000, would see a tax cut of $3,900. That's an estimate there from Natalie Nedley, who directs the master's degree in taxation at San Jose State. Lower income workers will see tax cuts too, though the dollar amounts are smaller. Some 73-year-old security officer who lives in San Jose criticized the bill. That is Bob Emmett. She estimates that Emmett, who rents an apartment, has no children, earns $16 an hour. In addition to some Social Security income, would see a tax cut, and he's lucky, at $546. Critics of the bill note that individual tax cuts will disappear in 2025. They may disappear before that, in effect, because of higher prices on other things. And this was a freelance software person that I've mentioned many, many times, Mr. Stool, in San Francisco. He makes $150,000 a year, accused few deductions, rents his house, holds no debt, has no children. Now he's getting a big deduction, a lower rate there. He works for Macy's, Exxon, and Cisco. Let's see. The tax plan mostly preserves a tax break for venture capitalists that had been in jeopardy. The so-called carried interest provision lets venture capitalists book 20% fees. They typically take on profit investments as a capital gain when the carries a lower tax rate than ordinary income. That has been the case in many things. Nonetheless, they are quite happy. He will be making less money. Chrysler said their income, U.S. tax reform will lift their income this year, 2017. That is the German car maker. The U.S. tax reform would result in an income benefit of 1.7 billion euros. That's 2.1 billion. 2 billion in a result there for Daimler Chrysler. Others not connected will lead to higher issues, not however, which the overall increase in net income turns to around €1 billion, the company says, without providing details. This is a 1.5 billion tax cut. Due to broad-based U.S. Industry and financial services business, combined with material added, Daimler, similar to many other local companies, benefit from the tax reform. The lower tax rates require a revaluation of net deferred tax liability at Daimler's U.S. subsidiary. So they haven't done that yet, so we don't know yet. And what else do we have here? U.S. consumer business spending boosts the picture. This is on the 22nd. Also, U.S. consumers spending accelerated in November. Shipments of key capital goods orders increased for the 10th straight month here. The bullish growth picture was dimmed somewhat at the figures also showed household savings. And this is something we look at very, very closely. Dropped last month to its lowest level in more than 9 years. Not good. Low savings could hurt consumer spending. But economists are optimistic about wage growth. Well, it doesn't work that way. Economists see a modest lift to consumer spending from a 1.5 trillion tax cut program. Consumers are still out there spending, but their purchases are being supplemented by low energy costs, credit reduction in savings, rather than organic income. That is a way of saying they are not paying as they are going. That is from Lindsay Krasler, chief economist at a fixed income fixed income in Chicago. Without sustained improvement in wages, consumers will struggle to maintain today's moderate pace of consumption. The Department of Commerce says consumer spending, which accounts for more than two-thirds of the economy, rose 0.6% last month after gaining 2% in October. Spending last month was buoyant on by an increase in demand for motor vehicles, recreational vehicles, and utilities. When adjusted for inflation, consumer spending increased 0.4% in November, unchanged from previous months. Personal income rose 0.3 last month, with wages increasing at 0.4. As a result, household dipped into their savings, which fell to $426 billion, the lowest level since August of 2008. You remember that's when the Depression hit. And down $466.9 billion in October. The savings rate is at a 10-year low of 2.9% from 3.2% in October. In addition to savings, consumers' spending is driven by record household wealth thanks to boom in the market. With the economy near full employment, economists argue that the tax cuts will only produce a moderate boom. That is true. Normally, when you have a full employment economy, you don't give a tax cut, you give a tax increase. They've got it backward. Signal the tax legislation signed it, that DJ Trump at 21%. We won't repeat that. Economists also believe companies will use much of the windfall and stock buybacks. Well, they've dressed that up by giving some bonuses out, but yes, they probably will use it on that. And inflation is tame, no doubt about that. The PCE, excluding volatile food index, personal consumption expenditures rose 0.1% in November, 0.2% in October. So-called PCE core price index increased 1.5%. We already reported that. We got a little bit ahead of this article. The Fed increased borrowing costs 3 times this year and has forecasted 3 rate hikes in 2018. There's little doubt that the structural shifts, including increased global competition, the growth in online retailing, new technologies that enable consumers to find the best price instantly and at a lower cost, are playing a role in holding down prices. No doubt about that. It is from Mr. Mark Ventnor, a senior economist at Wells Fargo Securities in Charlotte, North Carolina. A second report on Friday, this is from the Department of Commerce, says shipments of non-defense capital goods, excluding airplanes, a closely watched proxy for business spending, rose 0.3 after surging 1.3 in October. Core capital goods, we didn't report on that. I guess we didn't have it up. But anyway, to calculate equipment spending in the government gross domestic product measurement. Has risen every month since February, the longest stretch since the series started in 1992. Increase in core capital goods shipments over the last 2 months suggests a strong pace of increase in business spending on equipment in the fourth quarter. That used to normally be the case. We would get in the fourth quarter because people were having to write it off, so they would buy. I remember when we sold computer hardware here at Cranston on the other side, the software division, not the analytics division. But anyway, people were, small, medium-sized business were adjusting. Core capital goods orders slipped 0.1% last month after rising 0.8% in October. Real equipment spending has been a very strong run in recent quarters, but the most recent cooling in orders signal that there could be some softening to come. There's David Silver. He's an economist at J.P. Morgan in New York. In the third report, the Department of Commerce said new home sales jumped 17.5%. We already talked about that. A seasonally adjusted 733,000 units last month. That was the highest since July of 2017. We just said just before the Depression. They also expect the current tax plan to dent home sales. Next year. This is from the National Association of Home Builders. Sales of new family homes are projected to rise 5% in 2018. Only about half the growth for 2017. That's because of new tax. They will cap a deduction for state and local tax at $10,000. In major metro where property values are higher and taxes tend to be higher as well, middle-class family is going to get hit hard. That is from Joel Naroff, the chief economist at Naroff Economic Advisors, a Pennsylvania-based consultancy. The new rule should spur people to buy cheaper homes next year, a tendency that has already become popular in recent years, although the 50 millennials are shunning expensive living. Big home buyers, including Leonard and Patel Group, have suggested they will invest some money in entry-level houses. D.R. Horton, that's a big one, they're the largest home builders by numbers in the U.S., expects its cheaper brand, Express Homes, to grow at 10 to 5%. So you're moving downscale. The business aimed at first-time buyers makes up 37% of the number of homes sold by D.H. Horton the last quarter. Lennar and Pulte didn't respond. A prolonged shift towards entry-level houses should drive much of the growth in new homes. That's according to J.P. Morgan analysts. Sales of multifamily apartments, condos, largely rental properties, are expected to stay relatively flat next year. The Mortgage Bankers Association expects the median price of new homes to rise 4.5% next year, up from an expected 2.8% this year. That's kind of interesting in itself. Some analysts expect demand for new homes will remain robust, supported by further increase in jobs wages. They're expected from the tax reform. Appetite for new homes was strong this year, but home builders cannot properly benefit from demand due to tight labor supply and lumber, of all things. They have prices jumped, 39%. Analysts expect these challenges to persist in 2018. The Federal Reserve has already hiked interest rates. That will affect tax changes, price increases, interest rates. There's nothing good on the horizon for residential housing. So we'll see where that goes. On we go to the BBC. We've already talked about Bitcom. It's something away here. Let's go to do the numbers. We'll start the numbers now, finally, as we move along here with the BBC and stock markets, and then we'll do the commodities. This would be on Friday, unless otherwise noted. Here we go. The BBC Global 30 was down 0.12. The FTSE on Friday, all shares, we usually do it, was down 2.18. In Amsterdam, they were down 0.91. In Frankfurt, the DAC was down 36.95. In Paris, they were down 21.25. In Brussels, down 0.96. In Madrid, down 122.60. In Zurich, down 30.18. In Moscow on Friday, they were at 9.56. In Bombay, 184.0 and not 2. In Karachi, 712.44. In Lahore, they were down negative 45.11 and 0.22 in Colombo, and in Tehran on Wednesday, they were down 82. In Sydney on Friday, 11. In Tokyo, the Nikkei at 36.66 on Friday. In Hong Kong, the Hang Seng was at 210.95. In Shanghai, negative 3. The Dow was down 28.23. The NASDAQ was down 5.40. The Commodities Exchange out in the Midwest city of Chicago was down. That's the Merck was down 1.23. And in San Pablo on Monday, they were down 1,046.17. And in Mexico on Friday, they were also down. They've been down a very long time. 648.42 in the negative. And on to commodities. This is a very important part of the equation here, particularly Brent crude, petrol, gasoline, etc., what do you want to call it. All right, here we go. On Friday, it was up 14 cents a barrel. This is Brent crude futures at $65.04. On Wednesday, the spot was up 34 cents at $58.59. West Texas crude was down 9 cents at $58.27. This is above the magic $50 a barrel profitability rate. But at futures at $65, that means that petrol will be going up. Where does this affect the consumer? It's going to squeeze the consumer. This is winter, but become the spring and summer driving season. We'll see where it is. The Forex gold index was up $2.20 at $1,268.05. Dubai gold futures was up $8.60 at $1,278.80. Silver was up $3 at $16.17, also gained. And we'll go to Unex light futures here. Cocoa up again, $168. Robusta coffee, oh boy, I better go buy some coffee quickly here, at $1.79. And white sugar, I don't know why we even do this, was down 1.70. The Bloomberg Commodity Index on Wednesday, 85.59. This will do it for us. This is our, let's see, we'll have one more, I believe, report this year. Wait a minute here. Yeah, we will, on the 30th of December. Anyway, nonetheless, a happy Christmas to those in this world that on this day. This is the Christmas Eve in many parts of the world, particularly in North America and what have you. A both a religious and a secular holiday all rolled into one. Got to have malice to cook. And for those in business, next week, a productive one. The retailers are hoping for Christmas Eve, which is today, actually today, as a big sales day. A Sunday, they're getting an extra day in, so they can get those sales up. This is usually about 2/3 of many used to be retailers. It is changing now. This has been a long retailing season. When we start with Thanksgiving, Black Friday, Cyber Monday, all through here. I noticed on Amazon they're having the final 12-day sales or whatever they're having. So there's plenty of opportunities out there to buy for the consumer. Obviously, keep your eyes on the prize. From a little anecdotal information, I was out and about. Many of the consumers have already got what they're going to get. And I don't know about the after-Christmas sales this year, how they will turn out. It depends because you have more inventory control than, say, you did 10, 15, 20 years ago. So we'll see what we see.